how I pick my stocks. I look at specific metrics when I'm deciding to purchase a company or even purchase stock or shares in a company. When I look at my dividend portfolio, I have 23 dividend-paying stocks in it. The metrics that I look at work for both dividend-paying stocks and growth stocks, but one thing that I'm always paying attention to is even though I'm buying individual companies, I make sure that I'm well diversified into different sectors. With the stocks in my dividend portfolio, I received 107 dividend payments. That's close to 9 payments per month. I have more shares in specific dividend-paying companies because these companies spit out dividends more frequently that I can use to purchase other dividend-paying companies, which is pretty much a snowball effect of me receiving dividends and then reinvesting those dividends into other dividend-paying companies. The act of analyzing a company's performance and metrics to decide if you want to add it to your investment portfolio is called fundamental analysis. Fundamental analysis can be done at a high level or in more detail. When I talk about detail, I'm talking about you opening up annual reports, a couple of them, and then analyzing the numbers and trying to figure out how the company is performing. I like to keep it at a high level by looking at specific metrics. Those high-level metrics, I call that the company's report card. Let's say you have two kids, a son and a daughter. Both bring their report card to you. You look at your son's report card. He has all A's and B's. And then you look at your daughter's report card. She has a couple of A's, a couple of D's, and a few F's. Now that's quite concerning because if you look at your son's report card for math, history, and biology, he has all A's. But when you look at your daughter's report card, she has an F for biology and she has a D minus for math. So now you have to do some additional investigation to try to figure out why she has these bad grades. That's exactly how I look at analyzing companies. I use my high-level metrics to quickly analyze the company to see if the company is doing well or not. And then if a company is not doing too well, that's when I dive deeper into the metrics to try to figure out what's going on with the company. Is it something that's happening industry-wide, or is it something that's specifically happening to that company? What does the company do? The first thing that I look at, even before I look at any of the performance metrics when it comes to a company that I want to invest in, is that I try to figure out what the company does. If I know what the company does, and I'm able to explain it to somebody, that's already a great step because I don't like to invest in companies that I have no clue what their business model is or their business practices. If you can explain what a company does to a little kid, not only can you explain it to them, but it's also something that you can explain to yourself. And it's a clear sign that you understand at a high level how the company operates. You want to make sure that you're investing your hard-earned money into a company that you can trust and one that is reliable and stable. For example, if I take a company like Chipotle, it's easy to explain to even a kid what Chipotle does because all you have to do is drive up to a Chipotle, bring your kid in, and you show them that they sell tacos, burritos, burrito bowls, and even taco salads to customers. That's how the company makes money. If you take a company like Pepsi or Coca-Cola, that's an easy business model to explain also because Pepsi produces beverages. They produce more than beverages, but they are known for their beverage drinks, and they sell them through different distribution channels. So you take your kid to a Walmart or to any local grocery store, and you can show them how Pepsi is using Walmart as one of the distribution channels that they sell their products through. One thing you can also do is to open a company's annual report and go to the business section, which explains what the company does. Competitive advantage. The next thing that I look at is whether a company has a sustainable, long-term competitive advantage. Warren Buffett also calls this a moat. A company that has a competitive advantage over its competitor has a product or service that it can sell and then also increase the price on, and it will not lose any market share. For example, let's say you want to go to a fast food place and you want a burger. If you want a Big Mac, there's only one place that you can go to get a Big Mac, which is McDonald's. Or if you want a Whopper, there's only one place that you can go to, which is going to be Burger King, if you want to get a triple Whopper. Another example, if you grew up using a specific product your whole life, you're more than likely going to favor using that product, especially if your parents or your grandparents use that product. Think about a product such as Colgate or Clorox. If you grew up with these products, it is more than likely you will continue using these products because that's a competitive advantage that this product has. Some companies have what I call cash cows. These are products that a company produces, and they never have to change anything about the product over the years. So they can sell the exact same product for years and decades without even changing the product. They still have a loyal fan base. Think about a product like Coca-Cola or Pepsi. The opposite of a competitive advantage is a product that's a commodity. Think about sugar, chicken, or cement, because there's no competitive advantage with these products. Usually what companies try to do is lower the price and then get into a price war with the competition. Whenever a company has to lower its price just to stay competitive with the competition, that's not a good business model to grow your sales and your income. Meanwhile, a company that has a competitive advantage can increase the price of its products, and its loyal customers will still go ahead and buy their products. Revenue and net income. Digging into the actual numbers, one thing that I always pay attention to is consistency. So I'm not going to look at last year's performance. I want to see 5 to 10 years of performance and how the company is trending. So the first thing that I take a look at when I look at the numbers is the total revenue a company generates and the net income. What I'm looking for is a consistent uptrend with the revenue growing 3 to 5% each year. If you look at the graph of a company's total revenue, it's not going to be a straight line upwards. It's going to go up and it's going to go down. It might dip down a lot more, but the trend should be an upward trend. And then when I look at the net income, I'm also making sure that the net income is also increasing, just like how the total revenue is increasing. If a company is able to increase its total revenue, but they're not able to increase their net income, that means that the management team is not doing a good job of managing the company and making sure that they're not overspending in certain areas of the business. If a company's revenue is not able to grow, but you do see a company's net income growing, that means that the company is trying everything to cut costs, which is also not a good thing. A company is able to increase its revenue by selling more products or services, being able to expand into new markets, introducing new products to its customer base, and then also when they raise the price of its products. That's why it's important for a company to have a competitive advantage. Profit margin. A quick way that I can tell how well management is performing in a company that I want to purchase is by looking at the profit margin. The profit margin is when you take the net income and you divide it by the total revenue. What I'm looking for is consistency over the years. I would like to see my profit margins be in the double digits, so 10% or more year after year. If the profit margin grows higher than 10%, it is even better. The profit margin pretty much tells me how well management is performing on a day-to-day basis to keep the costs down, but keep their sales and revenue high. Return on equity. The next metric that I look at is the return on equity metric. This metric shows me how well a company is able to produce income based on its shareholders' equity, which is the capital that shareholders have invested in the company. To calculate the return on equity, let's look at an example. Let's say you have $20,000 to invest, and you invest $10,000 in company A and the remaining $10,000 into company B. In other words, your shareholders' equity in company A and B is both $10,000. Now, after about a year, Company A generates $1,000 of net income based on the $10,000 of equity that you put into the company. Company B is able to generate $3,000 based on the $10,000 that you invested in the company. The return on equity for Company A is 10%, 1,000 divided by 10,000. The return on equity for Company B is 30%, 3,000 divided by 10,000. Now, both companies have decided to pay out 50% of their net income as a dividend. So Company A takes that $1,000 and pays out 50%, which is $500. And Company B, 50% of the $3,000 is $1,500. The remaining earnings are put back into the company, also called retained earnings. Just looking at this example, you can already see that with the $10,000 that you invested in both companies, you're more than likely going to invest more money into Company B because Company B is able to generate more income based on your equity. Return on invested capital. Besides the return on equity, another metric that I look at is the return on invested capital because some companies manipulate their return on equity metrics. With the return on invested capital, you take the net income minus the dividends divided by the total capital. The next metric that I look at is how much debt a company has because the way a company handles debt is going to be a little bit different than the way you and I handle debt because companies usually use debt in order to expand or manage their business. When it comes to the debt metric, I like to use the debt-to-equity ratio. The debt-to-equity ratio shows me how much total liabilities a company has compared to the shareholders' equity. I like to see this number below 1, but every industry is going to be a little bit different. Another quick calculation that I like to do is to take the company's total liabilities and then divide it by the income that the company generates before taxes. Pretty much what I'm doing here is I'm trying to figure out how fast a company can pay off its liabilities, its debt, with the current income that it generates. What I'm looking for is 5 years or less. So if anything bad happened with the economy, how many years would it take for this company to pay down its debt with the income it generates? Share buyback. The following metric that I look at is if the company is buying back its shares. The reason why this is important is if a company buys back its shares, it increases your ownership of the company. You don't have to pay taxes on it, and it also increases the earnings. Let's look at an example. If a company only has 10 shares on the market and you own one of those shares, you own 10% of the company, 1 divided by 10. The company ends up deciding to buy back 5 of those shares and retire them. Now there are only 5 shares left. You still own 1 share of the company, but now your 10% ownership just increased to 20%, 1 divided by 5. And here's the interesting thing. Even though your ownership went from 10 to 20%, you did not have to do anything for it. You also didn't have to pay any taxes on your increase in ownership. However, if you sold your shares or even if you got dividends, then you will have to potentially pay taxes. And then also the third benefit is that if a company buys back its shares, that also means that the earnings per share more than likely is going to increase. If a company generates $1 million in net income and has 1 million shares outstanding, the earnings per share is $1. 1 million in net income divided by 1 million shares outstanding. That's $1. But if the company decides to buy back 500,000 shares and retire them, there are now only 500,000 shares outstanding. Then the earnings per share just increased to $2 because now you have 1 million in net income divided by 500,000 shares is $2 in earnings per share. Any company that can increase its earnings per share is more than likely also going to see an increase in the price of the stock itself, because a company that's able to increase its earnings is also a company that's worth more. Those are the main metrics that I look at, and this works well for growth stocks and dividend-paying stocks. But when it comes to dividend-paying stocks, there are some additional metrics that I look at. Dividend growth rate. The first metric is the dividend growth rate. With this metric, I'm just calculating the growth rate of the dividend year over year. So if the company paid out $1 in dividends last year and $1.10 this year, then the dividend grew by 10%. What I'm looking for is a company that can increase its dividend year over year, but they need to be able to increase it faster than inflation. So if inflation on average is 3%, I'd like to see a company that's able to increase its dividend year over year by at least 4%. And there are many blue chip companies that can do this. One thing that I always do is look at least 10 years of dividend increases, and even better, if there was any economic turndown. I pay attention to those years and what the company has done when it comes to their dividend payment, because some companies end up decreasing their dividend payments or even stopping their dividend payments in an economic downturn. For example, companies like GE or even Disney. That's why I'm always making sure that I'm looking at a longer period of 10 plus years to see if this company was able to pay an increasing dividend faster than inflation. Dividend yield. The next dividend metric that I look at is the dividend yield. The dividend yield tells you how much dividend you are getting based on how much you paid for the stock. So you're taking the dividend divided by the stock price. Let's say a stock is priced at $10 on the stock market, and the dividend that they pay out for the whole year is $1. Then your dividend yield is 10%. Most people would want to see high dividend yields, but you always have to be careful, because something that you might notice is that companies that have a high dividend yield usually have a lower dividend growth rate. And then some companies that have a low dividend yield usually have a high dividend growth rate. Which one should you choose? It depends. If a company has a high dividend yield, what that tells you is that up front, you're going to get more dividends for what you pay to get the stock. But the dividend growth might not be that fast. It might not grow faster than inflation. Also, you have to be careful with stocks that have a high dividend yield past 5%, because it could mean that the price of the stock is down. Think about it. If the price comes down, the dividend yield goes up. Usually, if the price of a stock comes down, that means that you need to do some additional investigation to see why the price of the stock is down. It could be something that happened with the company. It could be industry-wide, or it could be caused by an economic change. That's something that you need to investigate further. Another good tip is that you can look at the dividend yield historically to decide if this is just a blip in the road or if this is a concern that you need to pay attention to. Payout ratio. The last dividend metric that I want to look at is the payout ratio, which tells you how much dividend a company is paying out of the earnings per share, also called the net income. So what I'm usually looking for is a payout ratio of 40% or less. Every industry is going to be a little bit different. If a company has a 70% payout ratio and they generate $2 in earnings per share, they will pay out $1.40 in dividend income. There is a problem with companies that have a consistently high payout ratio, because keep in mind that dividend comes out of the net income. If a company's payout ratio is too high, then it might be the case that when there is an economic downturn and their net income takes a dip, more than likely the dividend is also going to get reduced or even canceled. Some companies also end up deciding to pay a dividend by taking on debt just to keep their shareholders happy and keep the dividend going. That's not a situation that I like to see for any company. Now, why do I go through the hassle of analyzing companies and making sure they hit their report card metrics and then adding them to a watch list? The reason why I do it is because it's fun for me. I like to create my passive income using various methods, and one of those methods is to create a consistent dividend income. It's something that I like to do by analyzing these companies, and once I buy these companies, I just have to hold on to them and then reap the benefits of all my work by looking at the dividend income that I get as time goes by. Dividend Growth Investment Portfolio Revealed. My dividend portfolio is something that I set up a few years ago, and even though it's a dividend portfolio, which only contains dividend-paying stocks, I'm also going to add some growth stocks to it in the near future. Now, the reason why I set this up was that I wanted to try something new back in the day, and when I learned about dividend-paying stocks, it sparked my interest. So I created a separate account because I already had the 401k and some Roth IRAs. But with my brokerage account that I'm using currently, I set up my dividend portfolio, and now it's a portfolio that manages itself. This means I'm getting passive income through dividend payments, and those dividend payments automatically get reinvested. Also, dividend investing to me is fun. It allows me to push my knowledge when it comes to analyzing companies, using fundamental analysis, and then buying them when they're selling at a discount. Dividend investing also gives me confidence when it comes to investing because I'm in the driver's seat and I'm making the decisions. It's not like when you invest in an index fund, an ETF, or a mutual fund where you have a fund manager that's making all the decisions. If you know how to analyze companies and you know how to invest in the stock market, you're less likely to get taken advantage of because you will come across people that tell you to buy specific stocks. So you might hear friends tell you to buy specific stocks or even family members, or you might even go to a financial planner, and he's going to tell you what you need to invest in. But if you have the knowledge already because you've been investing yourself, you'll be able to pick up when people are trying to bamboozle you a lot faster. And then the last thing, besides the passive income that I generate that keeps growing within my dividend portfolio, I can also take my investment portfolio and then pass it down, let's say if I had kids, or even pass it down to family members. And once they get it, they don't have to start from point zero because they already have an investment account that's splitting out passive income for them on a frequent basis. In my dividend investment account, I'm enrolled in a DRIP. This means a dividend reinvestment plan. This means that whenever I'm getting a dividend payment from a specific company, let's say Coca-Cola, that dividend automatically gets reinvested into buying more shares of Coca-Cola. Now, this is great because you're not only getting dividend payments, but you're automatically buying more dividend-paying stocks. So it allows you to grow your dividend income on autopilot. But one thing to remember is that even though DRIP is a good way to start when it comes to reinvesting your dividends, you still want to make sure that you're buying companies when they're selling at a discount. You don't want to buy a company when it's overpriced. It would be better not to be enrolled into DRIP and just receive the dividend into your account. Do your fundamental analysis. Have those companies that you want to buy on a watch list, and then only buy them when they're selling at a discount. But if you're just starting out, when it comes to investing in dividend-paying stocks, just go the DRIP route. So don't worry about buying those companies that are selling at a discount with just a few dollars of dividend income. Also, not all brokerage firms allow for DRIP, so always double-check the investment firm that you're investing with to see if they allow DRIP investing. Best time to buy dividend stocks? When is the best time to buy? I've already mentioned that you only want to buy when the company is selling at a discount. The first question then is, how can you tell if a company is selling at a discount? If a stock is trading for $1, does that mean that the stock is cheap? On the other hand, if a stock is trading for $1,000, does that mean that the stock is expensive? It's going to be hard to tell if you don't know what the underlying value is of that stock. Not because the stock is trading for $1 does it mean that it's cheap. If you have $1 in your pocket and a friend comes up to you and he wants to sell you a single piece of bubble gum, and he tells you, you know what, I'll sell this gum to you for $1. You're going to look at him like he's crazy because a single piece of bubble gum is worth less than $1. You could get a piece of bubble gum for 10 cents. $1 is way too overpriced. On the flip side, let's say you have $10,000 to spend and you want to buy a new car, and all of a sudden you see that they are selling the latest model Tesla cars for $10,000. That's the steal of the century because Tesla cars are worth more than $10,000 on the market. So you're getting the Tesla car at a discount. That's the way you need to look at investing in dividend-paying stocks. You need to know what the value is of the stock before you go and add it to your watch list and then purchase it. There are different ways that you can tell how much a company that's trading on the stock market is worth. Some investors like to look at, for example, the book value of a company. Other investors like to look at the earnings of a company, and then they look at the PE ratio. The PE ratio is a great way of trying to figure out what the company is worth because you're looking at the net income that a company generates, also called the earnings. If a company can increase its earnings, it also means that the company is going to be worth more. Let's say your friend has a company that generates $10,000 in net income every single year. He wants to sell it to you. So this business, let's say it's an e-commerce business, runs on autopilot, generating $10,000 a year flat. If he wants to sell it to you, how much are you willing to pay for it? If he wants to sell it to you for $20,000, you're buying a company for $20,000 that generates $10,000 per year. So you'll have your invested capital back in 2 years, and any income after that is going to be pure profit. You can then take your original investment of $20,000 and invest it into a different business. Now, let's say that another friend came up to you and he told you that he has an e-commerce business also, but it's not doing too well. Every single month, he needs to spend $4,000 on advertising just to get a few sales. So he spends $4,000, but he's not making any type of money. And he wants to sell this business to you for $20,000. You're not going to take that deal because you're not going to buy a business that's hardly generating any earnings. That's why the earnings of a company are extremely important. How much net income a company can generate, and can the company generate a net income that they can keep increasing year over year? These are the questions you should ask yourself and try to answer. On the stock market, we look at the PE ratio, the price divided by the earnings ratio. This ratio tells you the multiple of how much you're willing to pay for the earnings of a company. So with a PE ratio of 15, that means that you're willing to pay 15 times the earnings of a company. In essence, that means that you will get your original capital back within 15 years. If you look at it from the earnings standpoint, I like to look at companies that have a PE ratio of 20 or less. 15 or less is even better. That's how I decide when a company is trading at a discount or when a company is overvalued. If we go back to the example of our friend who sold us the $10,000 generating business for $20,000, the PE ratio would be $20,000 over $10,000, which is a PE ratio of 2. When to sell? When do I sell a dividend-paying company? I sell a company if that company changes or updates its business model into a space that they're not familiar with. For example, if a company produces chocolate chip cookies and then suddenly they want to expand their business and they want to jump into the technology sector, that's a big red flag because this company is used to generating income from selling chocolate chip cookies. But now they're jumping into a whole new industry. From a financial standpoint, you can already tell that there are going to be a lot of ups and downs, which might affect the dividends that they pay. Another reason why I sell my dividend-paying stocks is when the company cuts the dividend. Anytime something bad happens economically, or even if the company is going through some turmoil and it affects their net income, they might slash the dividend that they pay to their shareholders. And then the last reason why I sell my dividend-paying stocks is if a company stops paying a dividend. There are companies that have been paying an increasing dividend year over year, but then all of a sudden there might be an economic crash or an economic turndown, and they just stop paying a dividend. That's a big no-no, because companies pride themselves on paying out dividends to their shareholders, and especially if it's a blue-chip company. Those companies want to keep their shareholders content, and a big way to keep their shareholders happy is by paying out a frequent dividend. If a company pays out a dividend, but they might not increase their dividend as fast or even faster than inflation, I still hold on to the company. I bought stock in Walmart, and ever since they've been pretty much lagging with their dividend growth. However, the dividend that I do get, I just take that dividend income and invest it in another dividend paying company. Managing portfolio stocks. On average in the US, if you buy a dividend paying company, you get a quarterly dividend payment. Some companies might only pay twice a year, others pay monthly. If you have a big list of companies in your portfolio, 30, 40, or 50, it's going to be harder to manage and try to figure out if you're getting dividend payments and if they are increasing, if they are staying the same, decreasing, or even if one of the companies stopped paying a dividend. The way that I do it is I export all my dividend income in an Excel spreadsheet, and then I sort the dividend income by company, month, the dividend income. This allows me to quickly see if the dividend payments that I've been getting for a specific company are increasing or not. In the past, I had shares in Disney, but then the Disney company stopped paying dividends, and I saw that after I exported all the dividend income in my Excel spreadsheet and then sorted it and filtered it the correct way. And when I noticed that Disney was not paying a dividend anymore, I ended up selling them. The more dividend paying companies you have in your dividend portfolio, the harder it is going to be to manage them because it's not only about looking at the dividend paying stocks that you have in your portfolio, but you also need to stay up to date with them at least once a year because every year companies put out their annual report. You want to go through the annual report and make sure that those companies are still dividend paying companies that you want to have in your dividend portfolio. I recommend having between 20 to 30 dividend paying companies in your portfolio. Anything over 30, and it might get a little bit harder to manage. I say 20 to 30 because it allows for diversification between your stocks. You don't want all your eggs in one basket when it comes to investing. And when it comes to dividend investing, you don't want all your eggs in one industry basket. Best dividend paying stock. I'm always careful with recommending a specific stock or company that you need to buy shares in because the company might perform well today, but that doesn't mean that the company will perform well in the future. However, the stock that I'm about to reveal is a monthly dividend paying stock. Their goal is to deliver dependable monthly dividends that increase over time. That's exactly what I want as a value investor from a dividend paying company. I would add one more addition to their goal. They need to be able to deliver monthly dividends that increase over time, but that increase needs to be faster than inflation. Luckily for you and me, this company is able to increase their dividends faster than inflation year over year, or they're able to keep up and keep pace with inflation. The company that I'm talking about is Realty Income. This company can also be found on the stock market under the ticker symbol O. Realty Income is a company that buys commercial properties and then leases them to big-name tenants. Tenants such as Walmart, CVS, Walgreens, Taco Bell, etc. Realty Income is a REIT, also standing for Real Estate Investment Trust. Realty Income operates in the U.S. primarily, but they also operate overseas in Europe, Spain, and the UK. Realty Income was founded by William and Joan Clark back in 1969, and the company went public in 1994. The interesting thing about Realty Income is their business model, because from the start, Joan and William wanted to create a business that provided stable and dependable income for their shareholders. And they've been able to achieve this because not only has Realty Income been on the stock market since 1994, but they also lease to high-quality tenants. These are highly dependable tenants because even in an economic downturn, they're still able to pay their lease. Realty Income makes sure to create lease contracts for at least 10 years. There are exceptions, of course, and even if you're overseas or you go to a grocery store like Carrefour, it is more than likely Realty Income owns the property and it's leasing it to care for. And that's what I like so much about Realty Income because the dependable monthly dividends come directly from the dependable tenants. A big benefit of Realty Income is passive income. The monthly dividend that they pay out, you can start using that as passive income. Most companies in the US pay a quarterly dividend, but with Realty Income being a monthly dividend paying company, you can start using that as your passive income. One of my friends that works in the IT field wants to get into making more passive income since he's making earned income in the IT field and is making a good salary. He wants to transition slowly into making some passive income as well. And we've looked at and talked about different ways of making passive income with book publishing, creating his own YouTube channel, etc. But I keep telling him that investing in dividend paying companies, that's the easiest way to start building your passive income. And with Realty Income paying a monthly dividend, that's a great way to start your passive income journey. Realty Income has been able to increase its dividend 114 times. They've been paying a dividend since 1994, and there wasn't a dividend decrease since 1999. So that's over 20 years of dividend payments, which shows their consistency and dependability. That's the type of company that I like because you invest in the company once and you reap the benefits. And this allows you to sleep well at night because even if overall the stock market isn't performing well, you can still hold on to your Realty Income shares and still get that dividend because most companies in the US pay a quarterly dividend, so every 3 months you see a dividend payment being deposited into your account. And then if you look at companies overseas, it's not that consistent depending on the company when they pay out a dividend. Also, they might not even grow their dividends faster than inflation. That's why with this monthly dividend paying company, you're in good hands. For my portfolio, I use Realty Income as my foundation, and any additional dividend stocks that I buy are sitting on top of my foundation. What it will look like is that whenever Realty Income decreases its dividends, it increases my overall foundation, and the other dividend payments sit on top. But with Realty Income being the stable monthly dividend paying company, that's why I use them as my foundation. I've been invested in Realty Income for a couple of years now, so I've been getting my monthly dividends for a few years on time, every single month, around the middle of the month, and I've been buying additional shares. When I get my dividend, I either reinvest it into buying more shares in Realty Income, or I take that dividend and I invest into other dividend-paying companies. Another thing that I like about Realty Income is its corporate responsibility. With any company that I invest in as a value investor, I like to look at a company that generates a healthy amount of net income that can grow year over year, because if they can do that, more than likely, they're also going to be able to increase the dividends that they pay out to shareholders year over year. I also like to look at a company's business model, and I like to see what type of business this company is engaged in, because there might be some business models that you don't agree with. There might be specific companies that you don't like to invest in, which are in specific industries. Luckily for us, Realty Income has a safe and stable business model. Also, the Realty Income management team has been doing a great job of managing the business and then also growing the company by expanding overseas. I'm pretty sure that they're also looking at other countries to expand into because currently they have close to 12,000 commercial properties that they own. Since they've been in the business since 1969, they've been able to develop a plan and a system that's plug and play, so they know what to look for. They know how to analyze specific properties and specific locations, and all they have to do is plug their system in a specific location, and we, the shareholders, reap the rewards from it. When deciding when to buy a real estate investment trust or REIT, such as Realty Income, you cannot use the PE ratio. What you need to do is you need to take the E, which is the earnings, and substitute that with the FFO, the funds from operations. The funds from operations measures the performance of your real estate investment trust. What you need to do is take the P divided by the AFFO, which is the adjusted funds from operations. That's going to tell you if your company is selling at a discount or not. I'm looking at the AFFO from the annual report that Realty Income gave, and in 2021, it was at $3.59. Currently, the stock is trading at around $64. $64 divided by $3.59 is 17.8. I'd like to see that below 15, but 17 to 18, that's a good ratio also. Investing in your 20s versus your 50s. Why would you even think about investing when you're young? Because you still have your whole life ahead of you. You're not thinking about investing. You're not thinking about retirement. You just want to live your life and have fun. You might want to buy the latest video games or even the newest sneakers, and you might also be scared to start investing because you don't know where to start. The investing world is big and confusing, and you might need some help. However, when you start thinking about retirement, the younger you are when you start planning for your retirement, the easier it is going to be to hit your retirement goal. For example, when I was in my early 20s, I worked at a retail store, and this was one of the first jobs that I had. This company that I worked at had a 401k representative come through to talk about retirement and had employees ask questions about their 401k, their retirement, and any other miscellaneous questions they might have. I went into that meeting and I looked around and I noticed that I was the only young person in that whole meeting. I was in my early 20s and everybody else was in their mid to late 50s and up, which surprised me because even at a young age, I was already thinking about what I needed to do in order to be able to put myself in a position where I'm already financially free and I would be able to retire early and just live the life that I want to live. That was my whole mindset. But all the young people that I worked with did not have that same mindset. They were focused on buying the latest materialistic things such as headphones, new iPhones, and the list goes on. So if you're already thinking about retirement at a young age, you're way ahead of your peers. The employees that were in their 50s at the meeting felt defeated because they felt that it was too late for them to start investing for retirement. But even at that age, you can still catch up. It's going to take more effort, but you can still work on your retirement. Everyone's investing journey is going to be different, but if you're younger, when you start to invest, you'll be able to take more risks. You'll be able to invest in equities or even securities such as stocks that have historically been able to provide a better rate of return than fixed income assets like bonds. When you're young, you can invest 80%, maybe even 90% in stocks, but the older you get, and when you start hitting your 50s, you want to make that switch and start to invest in more fixed income assets such as bonds, annuities, and some dividend-paying stocks. Even when you're older, above 50 or 60, you still need to have a portion of your investment portfolio in stocks because you still want that rate of return that stocks could give you compared to fixed income assets. The biggest benefit that you have when you start investing at a young age is that you have a long timeline to build and grow your wealth. Because if you start investing at a young age, your money can compound for you. So the money that you invest, even if you start out by investing a small amount of money on a frequent basis, that money can compound. And when it comes to your capital compounding in the stock market, there are 3 ways this happens. It happens with capital gains, interest, and dividends. With capital gains, any money that you've invested in the stock market has the potential to gain in value, which is also called an unrealized capital gain. Now, the second one is interest. So if you invest in a fixed income asset such as a bond, you'll get interest payments on a frequent basis. And the last one, dividend payments. Dividends that you do get from dividend-paying companies are going to be reinvested in order to buy more shares of stock. Those 3 methods of compounding your money in the stock market are going to make it possible for you to invest a little bit of money, which will make your money compound and allow you to build wealth. If you graduated from college and started working and you have already invested, let's say, $2,000 in a 401k, and the company that you work at also gives you an employer match, you have $2,000 invested at the age of 24, and then every single month you invest $1,000, which is doable with an employer match. When you hit the age of 50, you'll be a millionaire. If you can get a rate of return of around 8%, inflation not accounted for. Now, if you're at the age of 40 and you still want to be a millionaire by age 50, if you take the same metrics by looking at a rate of return of 8%, and if you have $2,000 invested in your 401k, you will have to invest close to $5,500 a month just to be a millionaire by age 50. Starting at 24 allows you to invest significantly less because your money compounds over time. But if you start investing at a later age, you're going to have to catch up. In your situation, you might not start to invest at the age of 24, and you might not even have close to $1,000 to invest every single month. Everybody's situation is going to be different, but one thing that is important is that you have an investing goal, because when you start investing, you don't just want to invest just for the sake of investing. You do need to have a goal. Are you investing for retirement? Are you investing for a house? Are you investing just so you can buy a new car? Your goal is also going to determine where you need to park your money. Investing in the stock market is a long-term investment, 10 plus years. That's how you need to look at it. But let's say you just want to save up some money for a car or even for a down payment on a house. There are other financial vehicles out there that you can use. It might just be better to put the money that you are saving to buy a car in a savings account, a money market account, or a certificate of deposit. But with investing, try to stay away from the mindset of thinking that it should happen fast, because investing is a steady process. It is doable to become a 401k millionaire. You would just have to run the numbers in order to figure out how much you need to invest in order to become a 401k millionaire. The stock market is not predictable, but you can look at historical data and look at the rate of return over the years to figure out and plot how much you need to invest and how long it will take you to become a millionaire when it comes to investing in the stock market. If you are younger, it is more than likely you don't have the knowledge when it comes to investing in different types of securities. This knowledge comes with time, experience, and making mistakes. It's something that you need to take in stride and something that you need to learn from. Look at your failures not as mistakes, but as a part of the learning process. If you're younger, you might have some free time to try day trading or even options trading. But when you're older, you might not want to participate in high-risk, high-reward ways of trying to make money in the stock market, especially when you're older and you're close to retirement age or you're already retired. You don't want to stress over your capital or your money and the value of it going up and down. You want a steady stream of income that you can rely on. So fixed income assets will play a major role. Even if you can do anything outside of the stock market, for example, if you own rental properties through real estate, or even if you have a business that provides you with a stable, consistent income every month, that's what you can also be building towards in your younger years. Investing in crypto. Investing in the stock market is still going to be your best option, but in the world that we live in now, especially with crypto, I can also see crypto playing a major role in the future in how people construct their portfolios. Currently, you might have some stocks, some bonds, and you might even have some commodities. But going into the future, I can also see people and even companies adding more currencies like crypto ETF investments into investment portfolios. Anything you do when it comes to investing involves risk, especially in the crypto market. So crypto will be something that you need to pay even more attention to, as it's a lot more volatile than even some of the stocks that you can purchase in the stock market that I discussed earlier. If you're a lazy investor, if you're more of a set it and forget it type of investor, you don't want to log in and constantly pay attention to how your stocks are performing or how your index fund, ETF, or mutual funds are performing. And if you work at a company that also offers a 401k, more than likely you can invest in a target date fund. Some target date funds, once they hit that retirement age, stop rebalancing. But there are still some target date funds that still rebalance the portfolio after retirement age. Make sure to double check the target date fund that you're investing in to see if it's the one that does rebalance after the retirement age or if it doesn't. For this privilege of laziness, because you just invest in a target date fund and you don't have to touch it because everything is being done for you, for this privilege, you can expect a higher expense ratio because there's a fund manager that actively rebalances the target date fund, which you will be paying for. Also, if you want to invest in a target date fund, make sure that that's 100% of your investment portfolio, because if you're going to be introducing other securities besides that target date fund, you're going to mess up your asset allocation. Your asset allocation shows you how much money or the percentage of money is allocated to a specific investment, whether it might be stocks, bonds, crypto commodities, art, etc. When to start investing? There's no right or wrong age when it comes to investing, but the sooner the better, because as I mentioned earlier, if you start investing at a young age, you have all that time for your money to compound and build your wealth. You don't want to put off investing because before you know it, months will go by, years, even potentially decades, and you'll be wondering where all that time went. When you start investing at a young age, a good way to look at it is that you will be able to make time work in your favor, because the older we get, the faster time seems to be going. However, if you're older, you might be saying to yourself, I'm way too old to start investing. You're never too old to start investing, because if there's a company that you work at and that company offers a 401k, you have a higher contribution limit if you're above the age of 50, also called the catch-up contribution. This allows you to invest even more than the current limit just to catch up and allow you to grow your investments potentially at a faster rate. Custodial account. If you're very young, you might be under the age of 15, but you still want to invest. What you need is a custodial account set up for you. A custodial account can be set up by your parents or an adult supervisor. They're able to open the custodial account with any of the big-name investment firms. Once you have that custodial account set up, always invest with your parent or your legal guardian, because when you are at a young age, you do not want adult supervision when it comes to investing. Because when you are at a young age, you do want adult supervision when it comes to investing. If you're an older investor or an investor that's already retired, you might be invested in dividend-paying stocks. But if you're a young investor, it's okay to invest in dividend-paying stocks, even if these dividend-paying stocks don't grow as fast as, let's say, a growth stock, which has a higher rate of return. Even for a young investor, be sure to invest in dividend-paying stocks, because if you're young and you're just starting out investing, it's not always about seeing how much money you can make. It's also a learning process, and you want to know the ins and outs of some of the securities that are available to you. What you want to do is not put all your eggs in one basket. So don't put all your investment money in dividend-paying stocks, but make sure that you do have a few dividend-paying stocks or even a dividend index fund or dividend ETF in your portfolio. And if you happen to find out that you do like dividend investing, then you can always take it to the next level and start doing some fundamental analysis in order to analyze dividend-paying companies like a value investor would do it. The mindset is what I want you to keep in mind in order to start investing at a young age, and invest any amount that you can, even if it's a couple of dollars here or there, because your money will compound. 8 investing mistakes that will leave you broke. There's a lot of investing misinformation, and I'm here to dispel it. Some of these mistakes I've made myself, or I might know friends or family members that made some of these mistakes. Hopefully, you will learn from our mistakes. The first thing you must be careful of are the investing gurus. You always want to be careful of people talking to you and giving you advice on what type of stocks you need to invest in, because the biggest issue that I have with these investing gurus is that they will tell you when you should buy a specific stock, but they never tell you when to sell that stock. Not everybody that's giving you investing advice has bad intentions, of course, because some people just like investing. They get hyped up when it comes to companies that they like. So they might like Tesla, Google, or Facebook. Out of their good nature, they might tell you to go ahead and invest in Tesla, but you must always pay attention to investing gurus that have a financial component to the advice that they give, because there are a lot of gurus that get a kickback or commission if they promote a specific stock or company. So always do your research on who's giving you this advice. Is it coming from a person on the television, or is it coming from somebody on the internet? Always do a little bit of digging to see if there are any financial incentives tied to the advice that this person is actually giving you. The second mistake is investing without doing your research. So this goes hand in hand with the guru, because the guru will jump up and tell you what to invest in. You don't do your own research and you just jump and invest in that stock or mutual fund. This is a quick way to invest in companies that might be worthless. Nowadays, it's extremely easy to do research on a company because all this information is available online. All you need is the company's name or even the ticker symbol. You can search Google and start reading what the company does, how much the company is generating in revenue, sales, net income, how much debt the company actually has, etc. Don't just buy something on a hunch, and even if you want to be on the safe side, you can always invest in an ETF or an index fund that tracks an underlying index. The third one is thinking that it's too late to start investing. Sometimes I talk to people that are older, 50 and up, and they've never invested in the stock market. They tell me it's too late for them to start investing. But the way I always look at it is that you won't be able to work your whole life. There will come a time when you're physically not able to work. And in that case, you will need to have money available that you've generated over all those years and decades. You need to have that money working for you. So even if you think that it's too late to start investing, you still need to dip your toe into the investing swimming pool, because it's not only about you, it's also about your next of kin, which might be your nephews, your nieces, your kids, even other family members that you can pass your investments down to. And even if you're scared to start investing, you can always start by investing a little bit of money. Nobody tells you that you need to start investing thousands of dollars. You can start small. You don't even need to buy a whole share. You can buy a fraction of a share. So even if you have $50, $100, or $200, just start where you are. And when you do get more comfortable, that's when you can add more money to invest in different stocks, bonds, ETFs, mutual funds, etc. And when you invest a small amount, it's a lot less stressful, and it's also going to be a lot more fun. You learn the basics, and before you know it, you'll be adding more money to invest, or better yet, you can dollar cost average. And that brings me to the next one: being too afraid to invest in the stock market because people always hear horror stories. So they might know a friend or even a family member that put all of their money in a specific stock. That company ended up going bankrupt and they lost all their money. The problem with this is that not investing in the stock market might be a big reason why you will go broke. The money that you have might be in a savings account or even a checking account, but the money that you have in those accounts will not grow faster than inflation. When you invest in stocks or even bonds, at least your money is able to keep pace with inflation or grow faster than inflation. So your money retains its buying power. But if you earn your money and you put it under your mattress or put it in a savings account, which gives you less than 1% in interest, your money is going to be worth less over time. In this situation, your money is losing its buying power over time, and you're more than likely not able to work in your elder years. That's going to leave you broke pretty fast. The following mistake is being too emotional. When you invest, it's easy to get hyped up when you see the stock market in a bull run, which means on average the stock market is going up. And it's also fun to see your favorite stocks going up over time. But what happens when a stock crashes or a stock dips down? Are you going to be emotionally sound enough to still hold on to your stock? Or are you going to panic and sell your stocks? That's something that you will also have to learn. If you start investing with a small amount of money, you will see the value of your investments go up and down. But since you started with a small amount, it's not going to hit you that hard. It's only when you have thousands of dollars and even hundreds of thousands of dollars invested in the stock market, and you see the stock market dip or crash by 30% or more, are you going to get emotional then and start selling like crazy? That's something that you don't want to do on a hunch. Even if everybody around you starts selling, you still want to take a step back. Take a deep breath and really think about what you're about to do. More than likely, the stock market or the stocks, after investing in, especially if you're investing in an index fund or an ETF, more than likely it will bounce back. It might take some time. It might take months or even years for it to bounce back, but at least you're not losing your money because the money is still invested in the stock market. So the loss that you're seeing is an unrealized loss. It only becomes a realized loss if you sell that particular security. Mistake number 6 is falling for a pump and dump. This kind of thing goes back to the gurus I talked about earlier. So you will have somebody that advertises or tells you that you should buy a specific stock or specific security. They might not only tell you, but they have a whole audience that they are advertising to buy that specific stock. Everybody ends up buying that stock, in essence, increasing the value and the price of the stock. In other words, pumping up the price of the stock. And when the price is at its highest, that's when these unscrupulous gurus sell all their stocks in that specific company and they make a quick profit. Meanwhile, since they're selling, the stock price will go down and cause it to crash, and you're pretty much ending up with a stock that's worth nothing. This is the dumping of the stock. So you just got scammed by the pump and dump method. The funny thing is that my dad actually got scammed with a pump and dump. This happened back in 2004 or 2005. He got a phone call from an investment firm, which was pitching him a specific stock or a group of stocks to invest in. I was not listening to that phone call because I was not with my dad, but what ended up happening was that he invested in that specific security, and within a couple of months, its value tanked so much that it was worth nothing. That experience turned him off from investing for a long time. It wasn't until I started investing and teaching him some of the things to look out for that he got back into investing. He never told me this story. He only told my brother. And if he had told me the story when it happened, I might have also refrained from investing in the stock market. Luckily, I never went that route. Mistake number 7 is putting your money into just one or two stocks. It's easy to get excited about specific stocks or just put all your money in one specific stock. But that's the riskiest thing you can do because you don't want to put all your eggs in one basket. You want to spread your money across a multitude of stocks, bonds, and even securities. It allows you to lower your risk because if all your money is invested in one stock and that company goes bankrupt, you pretty much lose all your money. But if your money is spread out over 10 or more securities, even if one ends up crashing, you lose money in one. You still have a good chunk of money invested in the other securities. This also puts your mind at ease. It will also make you sleep well at night because you're not only focusing on one stock or investment, since it's spread out over so many. A good way to diversify without even having to think about it is to buy a high-quality ETF or index fund. Anything that tracks the S&P 500 is also a good start. The Vanguard company has a lot of good ETFs and index funds that you can invest in. This will give you instant diversification. Number 8 is timing the market versus time in the market. There's nothing wrong with trying to time the market. And I know day traders and swing traders that are experts at knowing when to buy and sell. However, even they themselves take losses. If you're just a beginner who's investing, or just a novice, timing the market will more than likely not work for you. It's better to just buy and hold, and over the long run, you will see your investment grow. Most people that jump into the stock market think that they can get rich fast, but investing shouldn't be looked at like that. For every one story that you hear of somebody getting rich fast in the stock market, there are millions of others that actually ended up losing their shirt. So look at investing as a slower process of building wealth and getting rich. 5 tips to get rich in the stock market. You have all these different avenues that you can use to make money, such as real estate or even crypto, but the stock market is still one of the best options and one of the easiest options to start building your wealth. The first step is setting a goal because it's extremely easy to just start investing without having a goal, because that's how I started investing. I just started spending money buying different shares and buying different stocks. I had no specific goal. I just jumped in because I wanted to learn how the stock market worked. But after purchasing a few shares of stock, I quickly noticed that I needed to have a specific goal when I'm investing in the stock market. If you think about a goal is nothing more than a roadmap to success. If you get out of the house and you take a taxi, your taxi cab is going to want to know where he or she is supposed to take you. If you tell them that you want to go downtown, your taxi driver has a clear goal. They have a specific location that they need to go to. After you've set up your goal, you need to know the steps that you need to take in order to achieve that goal. If you have a goal of having $1 million or even a $2 million investment account, that's your goal. If you want to hit that goal by age 40, the next step is to plan out your goal. So you can plan out the years that you still have in order to achieve your $1 to $2 million investment account. And you can also figure out what your rate of return needs to be on average every single year to hit your goal. And then you can also figure out how much you need to invest on a frequent basis using dollar cost averaging to hit that specific goal. Setting a goal is of the utmost importance. Tip number 2 on how to get rich by making money in the stock market is that you need to start investing in securities that can help you grow your wealth fast. Investing in the stock market has a lot of risks associated with it. How stocks performed in the past might not be an excellent indicator of how those stocks will perform in the future, but that's something that we have to look at. We can look at how stocks, ETFs, index funds, or even mutual funds have performed in the past, and based on that performance, we try to predict how it will perform in the future. If you want to grow your wealth fast in the stock market, a good place to start is by investing in ETFs. The reason why you want to invest in ETFs is because they are a passive way of investing. So you don't have to do all the fundamental analysis to make sure that you're investing in the right stocks or even the right fixed income assets. With an ETF, you get diversification depending on the ETF that you purchase. Tip number 3, make sure that you're investing in tax-efficient amounts. Nothing is worse than investing your hard-earned money, seeing it grow, and then having to pay a boatload of taxes on your wealth. That's why you must pay attention to which accounts you open and invest in. If, for example, you look at a traditional 401k, you invest with pre-tax money, so you invest your money before taxes are taken out, and your money can grow. And tip number 4 is having the right mindset when it comes to investing. And the right mindset when it comes to investing is all about consistency. Everybody nowadays has a shiny object syndrome, which means people are scatterbrained. One day they want to invest in the stock market, the next day they hear about crypto, and the following day they want to do real estate. When it comes to the right mindset, you just want to focus on investing consistently, making sure that you have that goal, and then executing it until you hit your goal. Having the right mindset when it comes to investing, it's not something fun. It's not something sexy. It's boring. But boring and consistency will lead you to becoming rich and building your wealth. The last tip, number 5, has to do with outside of the box thinking. You need to start investing for your kids or your family members that are growing up now. How awesome would it be if your parents or even your grandparents already had an investment account set up for you? And then when you're of age, you take ownership of that account and you just continue the investing process. Even when I look at my little niece and my little cousin, I went ahead and bought them their first share of stock, both in Coca-Cola and Disney, which will get them thinking about investing. I'm investing for them right now, and then when they're old enough, when they are both adults, they'll be able to take ownership of their investments. This is also a great way of getting kids involved in the stock market because school is not going to teach them how to invest. More than likely, their friends are not going to tell them the best way to start investing. It needs to come from somebody just like yourself who's interested in investing and is currently actually working on buying investments, buying ETFs, mutual funds, index funds, and working on building your wealth. The knowledge that you do gain along the way, that's the knowledge you can pass down. And even if you do not want to go the route of buying individual shares of stock, you can always open a custodial account and be the legal guardian and the adult supervisor of that custodial account.